That's for a little bit later on in the show. Right now, commercial real estate, how many times have people come on and said that's the next quote-unquote shoe to drop?
We don't have any more shoes left. That's many times. Right.
Well, you have plenty of shoes, but the other people that are limited wouldn't have enough. Anyway, John Levy is with us from John Levy & Company, is a real estate banking firm out of Richmond. And he joins us now to talk about commercial real estate. We'll spend the next few minutes doing that. Is that a fair characterization, John, that it is really the next shoe to drop? And if so, has it already dropped, or are we worried about things getting much, much worse than they already are?
Well, good afternoon, Connell. I think what you have to do is look at commercial real estate and say, what are we? Well, we are, one, a capital-intensive business, and we're a cyclical business. And right now, we have a restraint on capital, and we're in a real recession. So these are really tough times for real estate. But frankly, I think all of that is already embedded in the current market prices. People know that we're in tough times and that we've got a ways to go. So I'm not sure it's fair to say that the other shoe is going to drop. We're in tough times already.
So it won't be worse than we think, is your point. We already know how bad it's going to be.
I think that's exactly right. I think people have already forecast a fairly severe recession, probably ending the end of this year. Commercial real estate doesn't start to recover probably till the end of 10 into 11, but that's already in the forecast. It's not like that's a surprise to most people. It's painful, but it's priced into the models and into the market.
It's surprising to me, John, because you've said before that this is one of the roughest times in real estate that you've ever seen in your career, that we're going through somewhat of a violent deleveraging period. So are we still in that violent?
It is clearly a violent.
But it seems like the mood has changed. And even the way that you're speaking about it, it seems like you're saying, well, it's been priced into the marketplace. Yes, this is very tough. This is a very tough time, but this is in a sense priced in, not only in the market, in numbers, but also just the way that we're feeling about it. Is that a correct characterization?
Yeah, I think we are in the middle of a violent deleveraging, but there are actually some reasonably positive signs if you wanted to look for, the green shoots. For example, some 3 dozen REITs, Real Estate Investment Trusts, have raised over $12 billion in equity of recent. And that's the kind of thing we need. We're going to need more equity in our business as we delever into this market. And the next thing is private developers are going to have to start raising equity as well. But it's also,
can they do that?
This is really a phenomenal time.
Can they do that? Can they raise that money? I mean, you talk about just, do we need more intervention from the Federal Reserve, for example, along with that, or is it just simply about going out and raising money?
Well, we certainly need the government to continue with their programs. We need the TOLF program to work so that we can have a securitized market for commercial real estate. The commercial real estate business can't exist without a securitized market. And it's our feeling that we'll see the first of the new CMBS deals probably at the very end of this year or the beginning of next year. But that's really, really critical. So we've got to have a securitized market. But for lenders that have new capital now that they can deploy, this is really a great time to be in the lending business. Values are down. Spreads are at historic high levels. So if you're a lender and you can be active now, you're going to look back and say, this was the best time for me.
Explain real quick, you talked about a securitized market. I'm not sure that everybody understands exactly why, A, what that means, and B, why we need something like that hasn't existed, right, in quite some time, hasn't been functioning properly.
Well, that's correct, Connell. The securitized market in 2007 securitized in the U.S. alone some $240 billion. Last year in 2008 it was probably less than 15, and so far this year it's really been 0. So we've got to get that securitized market back. We don't have enough bank capacity, life insurance company capacity, and pension fund capacity to finance all of the commercial real estate. There has to be a securitized vehicle, and the TOLF program is part of getting that started, although we've yet to see the first of what I'm going to call CMBS 2, or the new commercial mortgage-backed securities market start. Again, probably the end of this year, first quarter of next year.
All right, John, hold on one second. We're going to bring in Hasim Najid. He's the Managing Director of Research Services for Marcus & Millichap. He's coming to us out there in San Francisco, my hometown, Hasim. It's great to have a voice coming from the Bay Area, because when we talk about real estate, it really is or it seems to be a regional story as well as a national story. We've been talking a little bit, as John was just talking about the securitized market. I know you have some thoughts as well about the securitized market, the role of the Federal Reserve, how all of this figures into the state of commercial real estate right now. Overall, can you give us a diagnosis of what's going on with commercial real estate and what the prognosis is going forward?
Sure. First of all, it's a pleasure to be a part of your program. Thanks for having me on. I agree that right now, one of the biggest challenges in the marketplace is the lack of financing. And CMBS, of course, played a significant role in commercial real estate finance during the last 5 or 6 years. And I also agree that it's pretty much shut down right now. I think it's going to take some time before the securitization model comes back. I believe it will come back. Our estimate is that it'll take probably 18 to 24 months before it is recognized as a meaningful part of the lending market again, in whatever format it does come back. Our estimate is that the fundamental core model of securitization is still very sound. What happened was over-leveraging and passing on the risk by the different parties involved in the origination and selling off of the loans into the secondary market. So with those issues naturally resolved by market forces and probably through some regulatory fixes that are likely to happen in the next 12 to 18 months, we believe that a form of the CMBS market will be coming back into the marketplace. In the meantime, what's happened is that commercial banks, of course, having had their own troubles, have pulled out of the market, with the exception of local and regional banks that are still lending on smaller properties. If you look at the property sales trends over the last year or so, you can see that over 92% of sales that are occurring in the United States are below $20 million. And those transactions are still happening because of the fact that there is financing still available for smaller transactions. The underwriting has changed. The qualifications for buyer is much more strict, and lenders are very, very cautious. And for a broad recovery in lending to come back, we have to see the economy begin to recover, which we don't anticipate will happen until later this year into 2010.
Right.
And remember that commercial real estate fundamentals, vacancies, rents, really lag the economy by 6 to 9 months. So we still have a ways to go to see the effect of the tremendous job losses we've seen in the last few months work its way through.
You know, it's one thing to say we have a ways to go, and another, Hassam, as you know, to say that this is going to be, and this is what people who aren't involved in the market day to day for commercial real estate are concerned about, this is going to be something that really hampers or drags down the economic recovery. That's why I was getting at that overused cliche of next shoe to drop. Is that something you still worry about for commercial real estate, or is it just a problem area that will play out over time and not have huge, broad macroeconomic effects?
I think you have to look at this cycle versus other cycles to answer that question. The first part of the answer would be the fact that commercial real estate was dragged into its current condition because of the economy and did not lead the country into the downturn. In previous cycles, because of overbuilding, commercial real estate in a large part caused economic problems. And so in this particular cycle, it is really showing more of a reflection of what's happened through the financial crisis and that trickling to the Great Recession that is now called. And it's really become a victim of it. With the exception of retail, which was seeing some overbuilding going on in the robust years, most product types were pretty disciplined in terms of not overbuilding. And therefore, commercial real estate in and of itself is having some problems because of the demand side of the equation, less so because of the supply side of the equation. And of course, the financing issue. If we begin to see an economic recovery in 2010, and if you couple that with the fact that a lot of lenders, especially CMBS, are now focused on workouts and really trying to avoid foreclosure, which is very different than what we saw in the early 90s, the last time we had a significant commercial real estate crisis, where the loan structures were on the balance sheet of commercial banks and the savings and loans. They became insolvent, the government took over, and those assets were marked to market and relatively quickly moved out into the marketplace.
Right.
This cycle is seeing something very different in that that process is being postponed and delayed. So I think the impact would actually be less. You also have to look at the vintage of the properties that are at most risk. It was really 2004, 2005 that we saw the very aggressive underwriting and competition among lenders resulting in very, very low standards of how the leverage got out there. So properties that were financed before that time saw very good income growth and were not over-leveraged. So we're talking about a segment of the marketplace that's a big segment, mind you, because the activity was so high, and we have a lot of maturities coming up. But the fact that there is a lot of focus on working out loans and delaying the standard foreclosure process actually gives the market a little time to recover while the economy starts to get its feet back.
And let me go back to John for a moment. And no doubt been listening to what Hassam's been saying. You pretty much agree with that, or you see it differently?
No. I think this is all about, frankly, about jobs.
Okay.
As long as we continue to show big job losses, commercial real estate is really in trouble, because if you don't have a job, you're not shopping, you're not renting an apartment, and you're not in an office building.
Yeah.
So this is really all about jobs. What the good news is, and I think Hassam and I agree on this, is there's not a whole lot rolling this year or even next year in CMBS. There's probably $15 to $20 billion this year, which is really a trickle, and maybe $40 billion next year. So we have time to get the CMBS market, or the new CMBS market, back to work. But I think we both agree the CMBS market has to work for there to be a recovery. But the real thing is, what happens to the global economy? Do we have jobs, or do we have another leg down? If we have another leg down, real estate, and commercial real estate in particular, is in trouble.
And here in the United States, we're asking our viewers, we're taking a live poll now, admittedly unscientific, it's just people that are watching and weighing in, but 8 out of 10 think the unemployment rate is headed higher than 10%, and a lot of economists think that as well. So, I mean, that's basically what John is talking about. What's your take on the job market and the impact that has potentially on real estate, on commercial real estate?
Well, the correlation is very tight, and of course jobs do drive demand for commercial space. There's a 9-month to maybe a 12-month lag between actual job creation and the absorption of commercial space. That cycle may have shortened a bit, but we do have to have jobs turn positive first before we can look at a recovery in commercial real estate fundamentals.
When do you think it'll happen?
Well, I think our expectation is that you've seen the trend basically start to ease in the last 2-3 months. Now, when I say ease, we're going from 5 to 700,000 job losses a month down to 350 last month. Just to give you a perspective, post the 9/11 tragedies and that shock, the highest job loss reported in a particular month for several months was about 350. So here we are, having eased back to the previous high of a shock. So I think it's at least 4 to 6 months of weakness in the employment market. I think we've seen the peak of job losses. Frankly, I think companies may have overreacted in some ways, and when the economy starts to come back, we might be surprised as to the level of hiring that will be necessary just to keep up with moderate demand.
John, quick thought. I know you wanted to jump in there, so what were you going to say about jobs?
Well, I guess my only point is, and I think Hassam and I probably agree, is that unfortunately, even though the losses have moderated, there's still losses. We really need the economy to start creating jobs.
Right.
And to create significant jobs before we see any real improvement in commercial real estate.
Right, and that seems like it's going to take a while. I think everybody seems to agree on that. John, Hassam, thanks to both of you for coming on. We appreciate it, because, again, we've been meaning to do a talk on this because everybody brings it up, and I think today we kind of got in depth into it, which was good. So thanks to both of you. We appreciate it very much.